United Parcel Service, stock ticker UPS, has had a decent March month, up around 4.2%, and if we zoom out year to date, up 10.5%. If we zoom out even more to 1 year, they are though down 5.5% roughly. So in this video, we are going to take a closer look at the intrinsic value of UPS. So if we go into the stock screener, punch in UPS, wait for everything to auto-populate, you can see the earnings per share was 13 at the last report. PE non-GAAP forward ratio of around 15.6, roughly in line with the 5-year average. The dividend yield is 3.3%, a payout ratio of 45%, which is pretty healthy, I would say. 52-week low of 154 and 52-week high of 209, currently trading at $193. The analyst target price is $192, which could indicate that the fair value is around the current levels. The EPS growth above 10% is at 20%, and the ROE, return on equity, is 67%. I would like to have it above 15. So far, everything looks really nice. You can see it had a bit of a dip not too long ago, and then ever so much it kept rising. If we jump into our dividend data tab, we can probably see some more data if we zoom in a bit here. So we do have the regular dividends, no special dividends coming out from UPS. Frequency, quarterly as always. Dividend growth rate was extremely high in 22. You can see 49%, which is also the main driver between the high dividend growth rate. If we zoom out, for example, dividend 3-year growth rate, 17%, 12% over the last 5 years, and 10% over the last 10 years. If we zoom out a little bit and ignore 22, you can see here it's around 5 to 7%. So I would probably think this is the normal level and not the 50% hikes that we saw in 2022. If we come down to the dividend yield graphs here, you can see currently, according to dividend yield theory, we do have an 8% discount. On the right side here, you can see whenever it goes into the blue area above the line, then it could potentially be undervalued. Whenever it dips below, it could potentially be overvalued. So if you believe dividend yield theory, this is the time to buy and this here is the time to sell. And scrolling down also a little bit here to the cumulative rate of return, you can see here UPS in the green line versus the S&P 500 in the red. It has roughly followed the S&P 500, though underperformed a little bit, as you can see here in the end. But as mentioned, we want to find out the fair value. So if we jump into our different valuation models, we do first have the Graham's revised valuation model, where we do take the EPS of the company, combine it with a PE of a growth growth company, the growth rate for the next couple of years for UPS, combine that with the average yield of AAA corporate bonds, along with the current yield of AAA corporate bonds, we do arrive at an intrinsic value of $145. Jumping into the next model, the discounted cash flow model, we do take the free cash flow from the different years. We then find out the average growth rate, and I have applied a growth rate of 3% going forward. We project the future free cash flow using that growth rate. We then discount them back to a present value, combining the present value with the perpetual growth rate, discount rate, the cash flow and cash equivalents, the total debt with the shares outstanding, we arrive at an fair value of $178. Next one is a dividend discount model, where we do take the dividend payout from the different years. We then apply a growth rate, in this case of 5%. As mentioned, we do have this growth rate of 49% to kind of skew everything. So I base it off the 6.5 here and the 5.2 here. Combine that with a weighted average cost of capital, we arrive at an intrinsic value of $212. Next one, multiples valuation, where we do combine them with some similar companies. In this case, FedEx and DHL, Deutsche Post. In this case, we arrive at a median and an average PE of 14.8. Combining that with the current EPS of United Parcel Service, UPS, we arrive at a stock price of $195. Using the free cash flow valuation, we take the price to free cash flow ratio from the different years again. We then take an average of those, combine that with the free cash flow per share from the different years again. We arrive at an intrinsic value of $215. The last one is the Peter Lynch model, where we have the growth rate, the dividend yield, and the PE forward ratio. In this case, we arrive at an intrinsic value of just $90. Before we jump into the summary, thank you so much for watching. If you've come so far, please subscribe to the channel and like the video. Let's jump into the summary, where we do have all our valuation models. Combining all those to an average, we do arrive at 172. I think the Peter Lynch valuation model is a bit on the low side, so I'll try to exclude that just to get a more clear picture. In this case, we arrive at an average intrinsic value of $189, with the current price being around $193. There's only a Negative current discount is supposed to be overvalued a little bit by 2.3%, suggesting that it is indeed fairly valued right now. Also, as we saw earlier, according to the PE being in line with the 5-year average and the dividend yield theory also putting it as fair valued. If I were you and you were interested in buying the stock, I would wait for a few dips. You can see if we just apply a margin of safety of 10%, the acceptable buy price will be 170. If we put in 15, 160, and so on and so forth. Right now, I think it is currently fairly valued. So if you are interested in, wait for a few dips. And obviously, if you like the long-term prospects of the company, do your own due diligence. But this is definitely an extremely nice company to own, I believe. But I think it's not really a bargain right now. Thank you so much for watching. I'll see you in the next video.